A great entrepreneur understands that you don't build the product and look for the market. A great startup entrepreneur understands that you build a market ready for your product. So in this video, I'm going to share with you why you shouldn't put so much effort building an MVP or a prototype to pitch to an investor, or primarily to pitch to an investor. I'm not saying an MVP or prototype is not important, right? I understand you have to build your prototype first and then you make it an MVP for the purpose of pitching to an investor so that you can raise funds. Now, the purpose of this video is to show you how you can literally raise funds without looking for money to build an MVP or taking so much time to build an MVP because you need the MVP to pitch to an investor. So one thing is certain, you need funds to build your product, launch your product into the market, grow your business, and scale your business. And that's basically the 4 stages of business: the ideation, the launching, the growing, and then the scaling. Now, however, I am saying, and I'm going to show you in this video, why and how you can build your product, and launch your business without seeking investors, and how you can do it. Now, am I saying that seeking investors is not good? No, that's not what I'm saying. And I'm not saying you shouldn't seek investor, or rather I am saying you shouldn't seek investor. Yes, you need investors, but you shouldn't seek investors. Investors should seek you. So in this video, I'm going to show you how you can make investors to come seeking you to invest in your business, and not you going about seeking investors. So that being said, I'm going to say some things in this video that you might not exactly agree with, and it's okay. So as a disclaimer, just know that what I'm going to say is literally going to probably change your mindset or make you see things differently other than the way you've been seeing it or you've been thinking about it as a startup founder or entrepreneur. Okay, that being said, let's jump into the conversation. So first of all, how can you build a business or build a product and launch your product into the market without relying on investors' funds? Are you building a business as a startup entrepreneur or startup founder because you want to quickly exit the business, or you're building because you actually want to run and keep the business for cash flow? Which one do you want to do, right? Because the fact is, you need to identify which of these you really want to do. Do you want to build a business for the sake of selling the business, which is you exiting the business, or you want to build a business to run the business, use it as cash flow, and most importantly, use it to create impact in the world? It is very important you ask yourself which of these you want to be, because it is the foundation of what I'm going to talk about, right? It is the foundation of determining, is the foundation that determines whether or not you should raise money from VC, from investor, angel investor, or if you should not, right? Because the fact is, many entrepreneurs do not even know the basics, like these basics, knowing what you want to do. Are you building to sell your business, which is to exit, or you're building for long term? Now, if you're building for long term, right, my 100% advice to you is, yes, you need funds, yes, you need investors, but you do not and you shouldn't. I mean, I'm not a financial expert. I am just saying you don't have to do what I'm saying, by the way, right? I'm just giving you my own recommendation based on my own experience, what I know works, and what I think is best for you. But again, you do not have to take my advice. I am not a financial advisor, or I'm not your advisor, whichever way. Anyway, so if you want to build for long term, I would not take investment from investor, whether VC or angel investor, at the early stage of my business. Yes, you heard me right. At the early stage of my business. At some point, maybe in my scaling phase, right? Remember I said there are 4 stages: ideation, launching, growing, and scaling. In the scaling phase, yes, I am open to take investment from investors because I need to scale. And the fact is this: if you really want to build a business beyond a unicorn, you need external funding. You need forces. Not because you need the money, you need network, you need community, you need global market forces to be in your favor. So certainly you will need investors to get those forces to be in your favor, right? So it's inevitable. However, there's a way of doing it, right? Now, I like to do it with a way of having investors to come pitch to me as against me pitching to investors. Now, and this is what happened in the startup game. In the startup industry, you find founders, they're passionate about a product that they are building based on an idea that they got. And the next thing they are doing is they're focusing on building first a prototype, which they will revamp or improved on to become an MVP. right? And then from the MVP, they start looking for investors to invest in their business. Now, the disadvantage of this is that the moment you look for an investor, especially if you're building for long term, you're not building to sell your business in the next 2 years, 3 years. You actually want to build a long term business or a legacy business that you can even pass to the next generation, your children, right? Your family, right? More like a legacy business, like I said, right? The first mistake they make is looking for investor to invest in their business. And the moment you do that, and let's say, for example, you find an investor, what literally happens is that you create what I call an exit. The moment you take on investors fund, right? Investors fund, you create what I call exits. Now, what is an exit? Exit means that you have to sell your business at some point, or you have to launch an IPO. So it's usually one of the two, right? But in most cases, when you take investment from an investor, aka VCs, venture capitalists, or capital firms, right? This is likely what's going to happen. They're going to sell your business, right? They're going to give your business out for acquisition to a bigger VC or a bigger private equity firm. That's most of the time what happens. In very few cases, we have seen where a startup eventually launch an IPO. Yes, there are startups that launch IPO. That is very true. But then the ratio is more of startup being sold to a bigger company, a bigger VC or private equity company, and then the lesser ratio launch IPO. What is an IPO? Going public. It means that the business is going from you owning the business as a private business, a private limited business, limited liability company, an LLC, into a public limited company, which means that you do not own the business anymore. The company, the public rather, the public, I mean individuals in the public now own the business with you. How will the individuals in the business, in the public own the business with you? They own it because you will have to offer shares. It's called public shares for sale, right? And I mean, there's a way you determine the amount of shares, the amount you want to sell the shares in the company, right? So you offer public shares for sale, and then the public buys these shares. The moment the public buy these shares, what happens is the members of the public literally becomes shareholders of that business. So they become part and owners of the business, right? You can't just make decisions without letting them know. So you have to be sending periodic emails, notifications, update about the company, what is happening, and then you have the shareholder board and all of those stuff, right? That is if you're launching an IPO. But in most cases, when you take investment from VCs or angel investors, what's likely going to happen is they're going to sell your business to a bigger VC company or a private equity company. Like I said, the foundation is that most entrepreneurs do not even understand this. They are just excited about their idea. The thing is, they just want to raise fund. That is it. They just want to raise fund, build a product, which is first a prototype, right? A prototype, and then an MVP. They just want to build a prototype, an MVP, which eventually leads to the core product, which eventually leads to the core product. The core product is what is launched into the market, right? Which is the main product. Now, with this prototype and MVP, right, this is what they use in pitching to investors, right? They use this prototype or MVP to pitch to investors for what? For funds. Okay. Now, so that they can go ahead and finish up the building, the development of the product, and then run marketing to launch the product into the market. So I want to show you what happens when the entrepreneur decide to raise fund from an investor, aka from a VC, right? So first, the point is they want to build a product, right? Good, which is fine. And the truth is, to build this, they need what? They need funds. Let me put that here. And this is inevitable, is the fact. It's honestly inevitable. You need funds to build your product, right? And another thing is, when you build your product, you do what? You launch your product into the market, right? What is launching into the market? To get what? Customers or users, right? Fantastic. This is very true. However, this is it. In the case of the traditional way, the startup entrepreneur, right? Because he doesn't even understand the basics, the foundation of knowing, am I building for long term or I'm building to just sell? I'm building for short term and then sell. What they do is they go ahead to raise funds from investors, right? So let's bring these down. Investors here, right? AKA VCs, angel investors, AG for angel investors, right? And in exchange, these people collect, they take what? Equity, which means they take part of the company. They become shareholder of the company. But that's not where I'm going in this conversation today. Now, I'm going to settle more about this product development. Now, in the system, the disadvantage of this is that because you need funds to build your product so that you can do marketing and then to get customers, what now happens is that because the entrepreneurs do not know any other way to get funds, they go pitch to an investor, and that creates an open, right? It creates an open for the investors to have equity. And once there's an opening for the investors to have equity, what happens is there will always be an exit. If there's an entry, there will always be an exit. And I've explained the exits to you a moment ago. Now, for startup entrepreneurs who want to build legacy business for long term, this system is not good for you. If you are building to sell your business, this is okay. This is fine. It's not entirely fine, but it's okay. The reason why I said it's not entirely fine is because I have heard stories, and I have 2 or 3 founders who have sent me messages in my DM on LinkedIn and saying that they need help. Like, I don't want to say this. Honestly, I don't want to say this because it's heartbreaking. Founders who have, in quotes, successfully exited their business, which means their business have been sold because they took on funding, but guess what? They are back to square one. They are left with almost nothing, right? Because when your business is sold, what you don't know as a startup entrepreneur is that the investor, the VC, is going to take most of the funds after tax. And you're going to be left with almost nothing. Why? Because the VC at the start of your business has given you some kind of funding, aka, let's say, $100,000, or in some cases, right, $1 million to grow your business, and you're excited. See, that is more like a payment upfront. And then you see founders and CEOs balling when they receive these funds from investors. You see some of them balling, living in nice, expensive apartment, traveling the world, hiring numbers of team members they do not need because they have a lot of funds with them. But guess what's going to happen? The VC start putting pressure on the founder and the CEO to start building the product as quick as possible. Why? Because the VC needs to make profits from the money he has given you already as investment. Because he is in business. The VC is in business. The investor is in business. And he's using his money to run business. You are a tool and a means to an end for the investors. Most VCs, rather, not every, right? I do not know all the VCs, right? But from statistics available to me that I have seen, most VCs like to exit a business between when they enter into a business, which is when they give funding to the startup, and when they exit the business, which means selling the business. That time frame is usually between 2 to 5 years, not more than 5 years. There are some VCs that stay in the business up to 7 years, but it's very, very unlikely that you find so many VCs staying up to 7 years. It's usually between 2 to 5 years. So you find out that once a VC gives you funding, right, they put the pressure on you to quickly build the product, because in the next 2 years, or between 2 and 5 years, they want to sell that business to a bigger VC. So this is the game. Let me show you the game that they play. And it's a game of profit. I mean, it's business. They are bootstrappers, like I would always like to say. And it's a game of profit, right? Now, this is it. The VC is an investor. The VC do not like to put money in the bank. He doesn't like to put money in the bank, because if he put the money in the banks, he's going to lose the money, because the money is sitting in the bank. It's not going to increase in profit, even if it's a fixed deposit, right? It's nothing compared. What they will get on the fixed deposit is nothing compared to what they will get when they use the money, when they invest the money. So putting your money in the bank is not investment. And wise people, rich people knows that that is not a way to grow a business. As a matter of fact, rich people, 80 to 90% of assets, financial asset of the rich, is not in the bank. It's not, okay, let me not say it's not in the bank. It's not in currency. I mean, cash. No, it's not. Right. So if you don't know that, you should know that by now. So it's not in cash. So what they do is they raise money from different sources, right? From angel investors, private investors, they put the money together and then they look for a startup because they need to invest that money to multiply. So for example, if they are giving a startup $100,000, right? What they are going to do is they always like to 10x, 20x, 100x their return, which means with this 100K, they need to raise approximately $1 million in profits after tax. The founder receives this, right? The founder receives this and then build the business and then they exit it. When they exit, this is what comes in $1 million. Now, what happens is this. You would think that the founder is going to get this $1 million. No, it doesn't happen that way. What happens is now the VC after tax now, let's go with after tax. So let's say after tax, everything that is left is, let's say, $600,000, 600K. The VC takes almost between 75 to, okay, let me know, let's say between 65 to 90% of these funds. Sometimes we've seen cases where VCs take up to 97%. So the point is, founders can't talk about it. They can't come out and cry and talk about it in the public because why? They have signed an NDA, non-disclosure agreement, right? So these are some of the things most founders do not know at the beginning. They just jump into it. Let's raise fund from VCs. And before you know it, you become an employee in your own startup, in your own business. You're building a business for a VC, for an investor. The investor uses you as a tool and a means to an end, which is their profitability. Because that's why they're in business. The essence of being an investor is to use your funds to get more profits, more returns. So they use, in this case, unfortunately, they use the founder. So am I saying that you shouldn't use VCs? You shouldn't use VCs or take funding from investors? That's not what I'm saying. What I'm saying is the point at which you take funding from investors is what matters. So what we recommend is do not take funding at the beginning. Take funding later. And I'm going to show you why right now. How do you raise funds to build your business without taking funds from VCs? Because yes, I get it. Most startup entrepreneurs do not have funds to build a prototype or an MVP or even to launch their products or their business into the market. So yes, they need funds. I get it and I agree. And I agree that you need funding and you need to raise funds because it's inevitable. So how do you raise funds? In the case of building a prototype, right, or an MVP, minimum viable product, to raise funds from investor. So if you want to raise funds, you need investor, right? Sorry, you need a prototype or an MVP to pitch to an investor. But in this case, what I want to show you is you don't need this. What you need is you need to create what we call a premium value offer. In other words, PVO. That's what you need to create. You need to create a premium value offer. Now, I'll tell you why. If you want to create a prototype or an MVP, which will eventually lead to your core product, like I said, core product, right? So, and this your core product is, another word for core product is your signature product that you're going to launch into the market. Yes, that's understandable. You certainly need this core product. And I honestly want you to build this because with this, you're going to help people. Your core product solves problem for people as a startup. Beautiful. You're going to build it. But hold on. Am I saying you shouldn't build your prototype or your MVP? No, I'm not saying you shouldn't. You will build it. But the challenge here with building your prototype or MVP at first is that you require funds to build this. You need funds to build this because you need team, you need people, you need to hire a team, you need to pay for software, for tools, and all of this stuff. And more so, it is time consuming to build this at first, which will lead to your core product or your signature product. So what I'm saying is this. What you need to do as a founder first is create a PVO, a premium value offer. What is a premium value offer? A PVO, a premium value offer, is a high value offer that you need to create that has a relationship with your core product. What does that mean? It means that if you're a SaaS company that is creating an image software product, for example, right? You create a PVO which should, not could, should be a digital product in this case. What do I mean by it has to be a digital product? For example, you can create a course, right, or a coaching program, right, or a mastermind program, right, program that what teaches about how to use your product that you're developing, that you want to build. Yes, you haven't built the product yet, but you can create a course to start teaching about it. Now, the thing is, because your product is not completely ready yet and people cannot have access to using it, you don't have to mention the name of the product yet. And I'll tell you why you should do that. So you create a course, a coaching program, or a mastermind program to start teaching about your product, your core product, even though your core product is not ready. So what you're doing by that is you're doing two things. First, when you sell the product, because it's a premium value offer, right? It's high tickets. So because the premium value offer, rather, you sell high tickets. You sell the course, the coaching, the mastermind, or even a consultancy service. Even a consultancy service, right? On high ticket. What is high ticket? You sell premium price. So you sell from anything from 2,000 upwards, 5,000, $10,000, $20,000, 35K, even 100K. If it's a consultancy service, you should sell anything from 30K upwards, up to 200K, 300K. And the revenue you get from selling this, you use it to start building your product, your prototype, or your MVP, which will help you build your core product, get your core product ready. I hope this is making sense, right? So you sell high tickets. You sell high tickets to raise revenue. That's number one, to raise funds for building your prototype, MVP, and then your core product. The next thing you do with the next advantage of having a PVO, which is the most important, is that while you are selling this offer, right? While you're selling this offer, at the same time, yes, you're generating funds, but most importantly, you are generating users for this product when it is ready. So in the case where you have to build prototype and MVP to go look for investors to raise fund, and then when you raise fund, you build your product, your core product, and after building your core product, you have to start doing marketing. With this strategy, first of all, you create a PVO, premium value offer. You use your premium value offer to raise funds, right? So your premium value offer could be in the form of a course, a coaching program, a masterminds program, or a consultancy service, which you can offer. And then for this, you have created your premium value offer. They pay you high ticket, which comes as the fundraising, as the fund you're raising, right? That's number one. But most importantly, the people who are buying your PVO, your premium value offer, they are automatically users, potential users of your core product when your core product is ready. So when your core product is ready, because now you have the funds to build it because you're selling the PVO to raise funds, right? And then your core product is ready because you've not built it with the funds you've raised. You do not have to start looking for the market to use your core product. Your market is ready because you have used your PVO to gather the market even before the product is ready. A great entrepreneur understand that you don't build the product and look for the market. A great startup entrepreneur understand that you build a market ready for your product. So once your product is ready, you take your product and present it to your already gathered and assembled market. That way, marketing becomes seamless for you. You do not need to look for people to use your product and give you feedback. You already have the market ready for you because why? You built relationship with them long before your product is ready. With this way, you will skyrocket your business from struggling to thriving. And once you start thriving, the next thing you need to start doing is start sharing your story on the internet, right? Get on podcast, share your story on YouTube, right? Get interviewed here and there. Just be out there, talk about the process of how you have successfully bootstrapped your business, grow your business without taking on investors' funding. And guess what will happen next? When you share your story, investors will start reaching out to you and say, you know what, we want to invest in your business. We see what you've done. You've bootstrapped your business. You've grown your business. You're self-sufficient. Now we want to invest in your business. And you know what you do at that point? You tell them, yes, it's okay. You can invest in my business, but on my own terms. You can invest in my business. I'm open to taking investment because, yes, I need your network to scale my business, not because I need your fund. But if I'm going to take your fund for you to invest into my business, you're going to do that on my own terms, not me doing it on your own terms. When you go by the first or the traditional way of building a prototype, an MVP, and then going about seeking investors, you will have to get their funding based on the terms of the investors, which will not be favorable to you as a startup entrepreneur. It has never been favorable to startup entrepreneurs and startup founders, right? But doing it the other way around, of building your business first, becoming self-sufficient using the strategy of creating a PV or premium value offer, and then you attain a certain level of stability, you share your story, you attract investors to you, then investors will come and say, you know what, we've seen what you've done, we want to invest in your business. At that point, you tell them, it's okay, I'm open to taking investment, but on my own terms. These are my terms. At that point, you can tell them, you know what, I do not want to exit my business. If you want to invest in my business, yes, it's okay, but I'm not exiting in the next 10 years because I'm building this for cash flow to create impact, or I'm building a legacy business. The investors who are interested in building legacy business with you for cash flow or whatever reasons, they will say yes. And the ones who do not want, yes, they walk out the door, and that's okay, because the truth is, at that point, you do not exactly need them. They need you because they need to multiply their funds. I hope this makes sense, right? And if you've gotten any value from this, I understand that you might have questions, but how do I create a premium value offer? How do I sell it? How do I create this? Yes, I understand that, right? And I can't share all of that in this video right now. However, it's a professional service that we offer in our company. Like I said at the start of this video, we help startups to raise funds. And we're currently helping a number of startup founders to raise funds for their startup companies, and we're helping them get liberated from investors, right? So if you want us to help you raise funds, we're 100% open to have a call with you. There's a link in the description of this video. You can simply click the link and book a call, or you can simply go to growhigheruniversity.com/fundraising call and book a free session, and we'll have a conversation with you and see how we can help you raise funds. That being said, I hope you've gotten some value in this video. And by the way, if you've not subscribed to my channel on YouTube, I highly recommend you subscribe, because I'm going to be sharing more details, more content regarding startup businesses, personal development, and how you can build a high growing profitable business, especially legacy businesses, right? So that being said, remember to drop your comments in the comment section. I would like to take your questions as well, so please drop those questions in the comment section. And most importantly, again, subscribe, so that you can get notification when I drop a new video, and then you can come watch the video, get tons of value, and grow your business successfully. That being said, thank you for taking our time to watch this video. My name is Wale Adebayo. I'll see you in the next video. Cheers.